Recent reports suggest that South Africa is facing economic turmoil. Since the announcement of a cabinet reshuffle at the beginning of this month, the South African rand has fallen with 4% against First World Currencies. Credit rating agency Standard & Poor then downgraded SA's credit rating to junk status. And now Moody is placing South African government bond ratings on review for downgrade. On Monday, the SA rand tumbled even further. Political and institutional uncertainty has placed South Africa under considerable fiscal risk. Meanwhile, the growth outlook for Namibia's economy remains poor, and economists speculate dire times ahead. In studio with us is economist and co-founder of Cirrus Capital, Roland Brown, on the effects of the political turmoil in South Africa has on our local economy. Good evening, ladies and gentlemen, and welcome to One Exclusive. With us in studio this evening is Roland Brown from Cirrus Capital, who's going to talk about the current political and economic climate in South Africa and how it affects us in Namibia. Good evening, Roland.
Evening. Thanks for inviting me.
Thanks very much for joining us. Now, let's just start with South Africa. What's happening there at the moment?
Well, I think the latest major piece of news in South Africa is that the third finance minister in 15 months has been fired and replaced with the fourth finance minister in 15 months. And subsequently, the rating agency Standard & Poor's has downgraded the South African economy to junk status. So this is one of three rating agencies that cover South Africa. And they're the first to downgrade them to junk. And we suspect that one of the others will probably follow fairly shortly. And then the third will downgrade them to one notch above junk.
Okay. And obviously, there's quite an impact on our economy because we are linked to the rand. Let's talk about that. I know that Carly Schlettwein, a finance minister, released a tweet yesterday that said our public debt is up by 1.6 billion. How is this situation in South Africa affecting our economy?
So I think, as you pointed out, we're joined at the hip with South Africa because of the currency peg. And this affects us in quite a lot of ways that I think are perhaps less known than the blatantly obvious one. Firstly, it affects our interest rates. There's something in economics called the impossible trinity, which I won't bore you with, but that basically stipulates that you can't have independent monetary policy, so basically independent interest rates, plus a currency peg without having capital controls. So we don't have capital controls, and we do have a currency peg with South Africa, which means we don't have independent monetary policy. And so now what's happening in South Africa will filter through to Namibia through a number of channels, including that interest rate channel. So first and foremost, we will see interest rates in South Africa definitely not being cut. Literally 2 weeks ago, we expected to see an interest rate cut in South Africa. That's completely off the table, and there's a chance of interest rates being increased in South Africa. If interest rates are increased in South Africa, they will have to be increased in Namibia as well. So that means that your man on the street, your Namibian household, will pay more for exactly the same car, exactly the same house, and exactly the same pieces of furniture that they currently have. They will become more expensive. The other thing is, because of that exchange rate that we share with South Africa, we also share inflation with South Africa. Because of the depreciation in the currency that we saw from 2015 until at the end of 2015, inflation in Namibia more than doubled between 2015 and 2016. We're quite bad at linking these cause and effect factors, but because of that currency blowout, we had this big increase in inflation, and that will just remain in place and even continue and possibly get worse going forward. In order to protect against this, the South African Reserve Bank might hike interest rates faster than they otherwise would have to, and then obviously that affects us. So there we have two options, either higher inflation or higher interest rates. Neither one is good for us. The third factor is the direct impact of the currency on our public debt stock, which is what the minister was talking about. Because we have quite a lot of hard currency debt, about 40% of our total debt is hard currency debt, and it's the vast majority is US dollar denominated. When the currency depreciates, our debt stock expands. And in the space of literally a week, that debt stock increased by 1.6 billion. If you consider what 1.6 billion can be used for in an economy like this, it's a great deal of housing, it's a great deal of infrastructure and so on that we can now no longer undertake because of that depreciation of the rand and the effect on the debt stock.
Definitely. And I mean, we are already stuck in a precarious position. Government announced, they're tightening their coffers last year. And I think a statistician general, Mr. Shimwafeni, said that the growth for the first quarter was almost stagnant at 0.2%. Let's look at these figures. What are we faced with now besides the South African turmoil?
So I think firstly, the 0.2% was the total growth for 2016.
Okay.
So in 2016, we actually went into recession.
Yes.
It's being talked about as a technical recession. It's just a recession. We
Yes.
went into recession. It happens to every economy in the world at some point. Namibia has had it before. We'll have it again in future. It's not a disaster per se. And this was driven by a whole lot of different factors. Firstly, it was driven by a lot of external factors that we have no control over. By far the biggest impact in that regard was the collapse in the oil price and the impact that had on the Namibian economy through Angolan consumers who used to come and spend a great deal in our economy purchasing houses, purchasing retail goods, and various other things, transport, education, medical care, all of these things, and that stopped pretty much overnight. So that was a very direct impact on our economy from external factors. Also, other commodity prices fell quite dramatically as well, and that affected our economy. We still, roughly 40% of our exports are raw minerals, and another roughly 20% are processed minerals. So we have a very, very direct link to commodity prices in the country, and when those commodity prices collapse, we feel it pretty much straight away. As well as that, we had a drought, and that drought came out of the last 4 years, we've had 3 bad rainfall years. Yes. And this is, it becomes sort of cumulative over time. And we had, these huge issues with regards to our dam levels falling to 1.6% of lowest abstraction capacity by December, major pressure on our manufacturing industry as a result, and so on. And then we had some domestic factors. So we have been increasing interest rates. We should have been doing it a lot earlier, but we have now been increasing interest rates. And the impact of those interest rate increases really came to the fore at the same time as all of these external factors hit us. As well as that, we've run expansive fiscal policy, so government has spent aggressively through the good years, and it's meant that our fiscal buffers have been limited for when we had this downswing. And so as a result of that, as all these external factors were playing against us, we also had to cut government spending and added fuel to that fire. And then we threw an additional couple of elements on top of it with some policy proposals which were disincentives for investment in the country. So the Investment Promotion Act, despite the name, is actually quite pernicious when it comes to attracting foreign investment into the country. And then the new Equitable Empowerment Framework and bill created a lot of uncertainty in the investment space for many of the Namibian investors. And so all of these factors came together to cause that very low growth. But now going forward, I think some of these factors are easing up. So we have seen rain. And we know how that affects Namibians and the Namibian psyche. We have started to see some improvement in commodity prices. Oil is slowly sort of stabilizing and starting to recover slightly, and we are slowly seeing a little bit more Angolan activity in the economy again. The fiscal position has improved a little bit as a result of a big payment from SACU this year. So last year we received 14 billion from SACU. This year we're getting 19.5 billion. So it's a 5.5 billion additional payment from SACU, which helps the fiscal situation quite a lot. We've stopped increasing interest rates, which also helps. But now, because of this rating in South Africa, it may change. That situation may change. But I think that the bottom line is that we saw this 18-month period of adjustment from sort of mid-2015 until the end of 2016, which was very, very aggressive. And we definitely won't see the same thing over the next 18 months. The situation will stabilize and slowly start to improve.
Now, you've mentioned that we are stabilizing, there's investor confidence, we're a peaceful, stable nation. And critics are saying it's time for us to have an autonomous currency from South African Rand. Let's talk about the possibilities of that.
Okay, so basically when it comes to a currency arrangement, you have 3 broad options, and then there's subsets within these options. So those 3 options are basically a free float exchange rate, a fully pegged exchange rate, or the intermediate, which is a sort of partially pegged exchange rate. Namibia has a pegged exchange rate, South Africa has a free float exchange rate, and Botswana has the intermediate one. So these are the sort of 3 options. The intermediate option, there's a few different ways that you can do it. But all of those options require you to have reserves. As soon as a currency's value is determined by the demand and supply of that currency. And if you look at what's happening in Botswana, they sit with a big reserve pile that allows them to artificially create demand or to provide additional supply of that currency. And so they can intervene in the currency in order to keep it more or less where they want it. And that where they want it is based on their long-term trading arrangements or their long-term trade with the rest of the world. So they know long-term it'll mean revert to more or less the right level, but they have reserves to be able to intervene in the meantime and ensure that it's not too volatile. Now that's very important for a small economy, and our economy is very similar in size to that of Botswana. If you have a free-floating exchange rate in a very small economy like one of our two, a single project like this Husab project would have moved the exchange rate massively. A single event like the introduction of this equitable empowerment bill and the outflows that resulted from that would have moved the currency significantly. And this creates a great deal of uncertainty, and it creates a whole host of other issues. So that option of going free float is not really an option. For Namibia, that intermediate option of an intermediate solution isn't an option because we don't sit with reserves. So basically, our options are to keep the situation or to keep the peg that we currently have, or to go to a completely free float. At the moment and for the foreseeable future, it is absolutely inconceivable that going to a free float would be a better arrangement than what we have. And the reason that we say this is, if you do a simple valuation of what the Namibia dollar would be if it was independent from the rand now, it would be about 15% weaker than it currently is. If you just take that alone, it means that our imports would be 15% more expensive, and we import almost everything that we consume. We produce a little bit of chicken, a bit of fish, some agricultural products, some pasta, some cement, but pretty much other than that, we import everything. And so that would all increase by 15%, but that wouldn't actually be the end of it. We have a lot of companies in Namibia that have Namibia dollar assets and rand liabilities. Now, in order that those remain more or less balanced, if the currency were to depeg, then that balance could be lost. And if you see a 15% depreciation in the value of your assets versus your liabilities, it erodes your equity. In the event that there's a build-up to a currency depegging, a lot of corporates in Namibia would take money out of the country in order to reduce their Namibia asset exposure vis-a-vis their rand liabilities. In the event that that happens, you'll have big outflows from the country. You'll see much less investment into the country with all of the uncertainty. And that depreciation would not stop at 15%. And our estimate is that if we depegged from the rand, it would be a roughly 60% depreciation in the value of the currency within a year.
Okay, let's just paint the worst case scenario picture. If there were, for instance, a civil war to break out in South Africa, what would that, if we're not going to delink in the near future, maybe in 50 years' time, would it be a possibility?
So I think that the basic decision around delinking would stem back to the strength of our economy. Okay. So I think if we can grow our economy, and if we can grow some of our manufacturing capabilities, some of our service capabilities and so on, that we are much less vulnerable to these internal and external shocks, then it becomes more of an option. The other thing that would make it a relatively more attractive proposition is if something goes really badly wrong in South Africa. So like you say, if there's a civil war, perhaps one example, more important for me, if we see an erosion of property rights in South Africa, all your big banks move out, all of your big financial services move out, your manufacturing companies move out, and that economy shrinks dramatically, then it would also perhaps make sense for us to consider that. That's a really inconceivable thing at the moment. But should it go that way, then certainly. What I would say is that one day Namibia will decouple from the rand. We hope that it'll be by choice, but it will be by choice at such a time that our economy is strong enough to be able to have a free-floating exchange rate of our own.
Okay, let's quickly talk about expansive fiscal policies. Let's talk about the wage bill. Now, NDPU 3, 4, and 5 focus a lot on employment creation, and what we see is a bloated civil service. Not a lot of people understand the connection between that and the volatility of our economy. Let's talk about that wage bill that the Ministry of Finance has now said they're not going to be changing.
Okay, so I think that the message about the wage bill tends to stem from the Prime Minister's office rather than the Ministry of Finance.
Yes.
But I mean, what we've seen in the last budget is a 15% increase in personnel expenditure. And if you go through the different ministries, it's very different from ministry to ministry. In defense, it's a nearly 30% increase. This is totally unsustainable. I think that we have to be very, very clear on that. This is not something that can continue in perpetuity. The other thing that we have to be very clear on is that the way that we address this, we have to be sensitive. The last thing that you want, and it can cause far more issues than it solves, if you go in with a blunt approach and you try and slash jobs here, left, right, and center, and you cause social unrest and you chase investment away, and you get in the public news headlines around the world for all the wrong reasons and so on. So we have to be sensitive to how we address that problem, but we have to address it. The reason that we have to address it is that now wages and salaries plus the basic utilities, S&T, the electricity bills and all of those things that go with creating jobs, those two factors alone total more than 50% of total expenditure. That's before you start looking at the cost of building all the office buildings that government people work from, plus before you look at the transfers to state-owned enterprises, much of which ends up in operational expenditure and ultimately in wages and salaries as well. So the vast majority of our budget goes to directly employing people. The logic behind this is that we have an unemployment issue in Namibia, and we have a major youth unemployment issue in Namibia. Roughly 30% of our population is unemployed and nearly 50% of our young people are unemployed. And this is obviously a situation that we have to address. The big concern around the wage bill, though, is the question of, is government creating jobs directly the optimum way of addressing this problem? And the answer is an absolutely unequivocal no. It is not the correct way of creating jobs. In order to efficiently and effectively create jobs, we need to ensure that we have a business environment that attracts investment into the country, and we need to ensure that we can match the skills available in the country with the demand for skills. So firstly, we need to create that demand, and secondly, we need to ensure that the skills are there for that demand. So that means addressing issues in the education system to align the supply of labor to the demand for it. And the other side of it is it means creating a business environment that attracts investment into the country. Putting in place bad legislation and bad policy around investment will do the exact opposite of creating jobs. Plus, it has this other negative impact of ensuring that revenue to government is negatively affected. And that means that government's ability to create jobs is curtailed. The other side of this, which I think is equally important, is that there's some conventional expenditure for government that is required in order to ensure that private sector can create jobs and pay taxes, which create more jobs through government. That means that we ensure that we have infrastructure that can make sure that the city of Windhoek is adequately supplied with water for our manufacturing plants that employ people and pay taxes that ultimately employ more people. So that we can ensure that we have sufficient electricity for our manufacturing sector, so that we can ensure that we have safety and security and all of these other things which are conventional sources of stability for a private sector to function properly. If we spend all of our money on employing people directly, it leaves us with inadequate resources to do those other things. And if we sit with inadequate resources to do those things, ultimately it feeds back into government's revenue and government's ability to employ people, and once again means that there's insufficient resources to do those other things. And you can get yourselves into a very negative spiral as a result of that. That is a risk that we face at the moment. It's not an imminent risk, but it's certainly a risk if we continue to increase personnel expenditure at the expense of critical infrastructure. What I would say, though, at the moment is that personnel expenditure is too large and it needs to be brought under control relative to the rest of the budget. But even then, there is still scope within the rest of the budget to allocate funds better to provide for the capability of private sector to create more jobs. So if you look at the conventional role of government, the conventional role of government around the world is not to create jobs directly. It's to create an environment that creates jobs, to collect revenue from that environment and deploy that revenue back into ensuring that that environment remains positive for job creation, and then to address issues with regards to the allocation of capital, the allocation of wealth, should it become very unequal. So you do this through the provision of schools, the provision of free or subsidized healthcare, and these types of things to ensure that you can create some form of equality. In Namibia, there's a different or an additional role for government, which is to do some redress of some of the inequality that we have as a result of the previous oppressive system of government that we had in the country. And in that space, there's a role for redistribution. That redistribution needs to be strategic in such a way that it's not taking what we currently have and splitting it up over millions of people, but it's ensuring that the public as a whole can benefit more equitably from the resources that are available, plus can be part of growing the economy, can be part of the longer term economic gains that the country will undoubtedly make.
This morning you were in a national budget review with the Ministry of Finance. Tell me, which, compared to last year's budget, what are the big things that have happened? Which industries are still going to face considerable strain?
Okay, so I think if you look at the budget documents and you compare this year's expenditure to last year, there's really just 3 lines that have seen an expansion in expenditure. So these are 2 interest cost lines. So it's domestic interest and foreign interest, and then personnel expenditure, which I think we've discussed. Almost every other line is seeing cuts in expenditure. So I think there are a few sort of places which are going to feel the pressure of this particularly, or through a few sectors that will feel the pressure particularly. Starting with construction. The construction industry employment numbers literally increased 4-fold between 2010 and the end of 2015. And we believe that we're now in a process of that number halving again. So we're definitely going to see an upswing in unemployment, and particularly unemployment of people who were previously employed in the construction space. This is down to a number of factors. This isn't just the budget, or this isn't just government expenditure. We had 3 mines being built consecutively in Namibia between 2012 and 2014. This was a first for the country, never happened before. The last one of those mines has just finished construction at the end of last year. As well as that, we had a classic late phase expansion boom in terms of additional floor space being added in our retail outlets. And that has completely come to a halt as a result of many factors, none less so than the Angolan situation. So there's been a big slowdown in that space. And then government was running a big expansive capital budget, and that's been rolled back far more quickly than the other expenditure in the budget. So we've seen huge cuts in capital expenditure from government. So these 3 factors will definitely mean that the construction sector remains under quite a lot of pressure. The other sector that I think is going to be under quite a bit of pressure going forward is your retail space. Again, it links back to the Angolan activity, but it also links back to the general slowdown that we saw in the economy. When the economy slows, you tend to find that people have less money in their pockets to spend. Added to that, there's a liquidity situation with the commercial banks at the moment that ensures that they are not nearly as well positioned to continue lending the way that they have been previously, and so we'll see a slowdown in credit extension, and that will also hit the retail space. And then government is cutting expenditure dramatically for things like vehicles, for office cool drinks and office retreats and things like that. So there's that wholesale retail space, I think we'll still be under pressure for a little while going forward. I'd say those 2 are the main ones. But I think otherwise, this year we'll see a big increase in diamond output. This year we'll see improvements in agricultural output. We'll see improvements in manufacturing output. Construction, as I said, will remain under pressure, and wholesale and retail trade will remain under pressure. But I think our conventional business sector will do relatively well again this year compared to last year, not compared to what we saw 2 years ago, but it will start to improve again. And then the other big factor there is that we are seeing quite a lot of pension fund and life insurance money brought back into Namibia at the moment as a result of regulation changes. And that money will be deployed into our banks. It will be deployed into some government securities and fund some other private sector real economy activities as well. And so I think that towards the end of this year, we will start to see that situation ease up a little bit as a result of those fund inflows as well. But I think, the 2 main sectors that we still need to be a bit cautious on are wholesale and retail trade and construction.
Brilliant. Thank you, Roland, very, very much.
Most welcome.
Viewers, that is all from us this evening on One Exclusive. Be sure to SMS your comments to 555 or watch this clip on social media and tell us what you think. That's all from us for now. Good evening.